I'm Wendy Tyrrell. I'm the Executive Director of the Development Partner Institute. Really delighted to be here to moderate this session at the LIAMforum on Green Finance Comes of Age, the financial sector and the sustainability agenda. I have three amazing speakers who've come from across the world to talk with you tonight. So first of all, I have Lisa Sachs, and this is the order they're going to speak in. Lisa Sachs. Lisa is Director of the Columbia Center of Sustainable Investment in New York City. Aaron Field, who is Assistant Treasurer at Anglo American in London. And Fernando Ruiz-Meyer, who is Senior Operations Officer at IFC in Bogota. And I am Wendy Tyrrell. I come from Australia. I lead the Development Partner Institute from Australia, but I'm in London at the moment and very pleased to be here because it's 4 a.m. at home. So it's a much more reasonable hour here. So I've got a fantastic panel. It's an absolutely fascinating topic. And I've asked our speakers to enthrall you with their stories of why they do what they do, and also to talk about green finance coming of age. And Lisa's going to draw the big picture, and Aaron and Fernando are going to speak about some very specific examples of green finance that they've been a part of, and very exciting. And then we've got time for questions, so for you, the audience, to bring your questions, and I have some questions as well. So I'm going to hand it now to Lisa to take us away.
Great. Thank you so much, Wendy. It's really a pleasure to join all of you, and fantastic group that you've convened. I look forward to hearing from my fellow panelists. Saying that this is a topic that has motivated my career for the past 2 decades, and so I'm thrilled to share with you why I'm so passionate about it and how I see things right now, because this is also an incredibly important and dynamic moment for sustainable finance. I think a milestone to start was in 2015, which was one of the most important years of our generation. All of the world's governments agreed on 2 historic agreements: the 17 Sustainable Development Goals, which comprised Agenda 2030, that set out the agreed development framework for the years 2015 to 2030, and the Paris Climate Agreement, which encompasses the global commitment to avoid catastrophic climate change. It was historic for the world to agree on these critical agreements, which chart the path toward ending poverty, toward promoting inclusive global prosperity, to preserving our environment and climate. But realizing these goals will require trillions of dollars of investment each year, more than is currently invested. That will come from a variety, it needs to come from a variety of sources. A lot needs to come from the public sector, from governments through development finance institutions, and a lot needs to come from the private sector, which has more than enough capital to finance these the pathways charted in these historic agreements. But at the moment, nowhere near enough finance is being mobilized to achieve these goals. So we have a historic opportunity and a responsibility to mobilize the financing needed to achieve them. There's a less nice side of the same coin, though, which I would be remiss not to mention, which is that we are facing real crises on the planet. We are facing environmental crises, irreversible climate change, pollution, irreversible loss of biodiversity. We're facing social crises of extreme poverty, of preventable disease, of massive and widening inequality. Inequality is getting worse within countries and among countries. And these crises are also the direct result of our global economy. So we're at a pivotal moment in global finance. We need to finance the transformative change that our world needs, and we have the responsibility to halt and to reverse the crises that our current economic system is creating. So these are, to my mind, this is the big picture of sustainable finance. It's an incredibly dynamic space right now, as there's increased recognition of both of these trends. There's increased pressure on financial institutions and increased recognition of the risks and of the opportunities, evolving regulatory frameworks that will shape some of the financial flows. So what happens in this field in the next few years, to my mind, will be absolutely decisive in whether we're able to achieve our global goals or not. So I'll pause there for the moment.
Lisa, that's fantastic. Where have you already seen the most significant shifts?
That's a really good question. I think the most significant shift has been the recognition that the crises faced by society and the planet are a real risk to the financial sector as well. That has been to my mind, now that's a universal recognition. The fact that the financial sector can't actually ignore some of these challenges. So almost every financial institution now is thinking about to what extent they are exposed to some of these risks, how their products and how their services and how their engagement with their financed entities are influencing some of these outcomes. So I think that the recognition of the challenge and of the responsibility and of the risks has been the most profound shift. Where I think it's been harder and slower is in really figuring out what the solutions are, and what the responsibilities really are of the different actors, but not only the responsibilities, what mechanisms can each of these different financial sector actors do through their products, through their engagement, and otherwise that will actually help to achieve the solutions. That's where I feel like there's the movement is only growing.
That's fabulous. Thanks, Lisa. And I'll come back and ask you, I think, to explore more about the mechanisms that you see have potential. But I'm going to now go to Aaron. And Aaron, if you could talk about what's drawn you to finance and what you love about it, what you're passionate about it, because remembering that our audience is young people who are looking to the future of their careers. So also sharing your passion as Lisa has. And if you could talk about the bond and also the sustainable linked loan that you've developed at Anglo American. So over to you. Thanks, Aaron.
Sure thing. Can do. Hi, everybody. So I'm Aaron. I'm the assistant treasurer for Anglo American. Anglo American, big mining company. We've got operations all over the world, and I joined them in South Africa, straight out of university. In fact, I was a maths and economics grad. Went looking for some VAC work and stayed after that. It's a company I'm very proud to work for. In South Africa, it's one of those names that that everybody has an uncle or an aunt that's worked for them at some point. It's a very big firm. And I think it's very aligned to what I was looking for coming out of university, was to be part of something that was bigger than myself, a business that was really making an impact. As a mining company, we make physical impacts and big holes in the ground, but we really make great impacts on the communities around us, around our operations as well. And so to be part of that, whilst also being just a nerdy finance and risk guy as well, is tremendous. And I really enjoy playing my part in that role. I'm the treasury function, for any that aren't familiar with it, is pretty much about sort of managing cash and raising cash. I kind of think if a company were a house, treasury manages the mortgage and buys the foreign exchange to go on holiday with. So I have a team here in the UK and in Brazil, and we manage the loans and bond raising activities for the group, as well as the cash we generate at the foreign exchange, and interest rate risks, and in all the inherent risks of dealing with various counterparties to do that as well, for the Anglo American group. And then we reflect that internally, and we mobilize the capital within our group to make sure that we can achieve those goals. Develop the new mining assets, that we can support the sales and trading activity of those commodities as well. And so, as my career thus far has very much been finance focused, but as Lisa mentioned, just this trend, although admittedly we're coming somewhat later than 2015, but in the last couple of years we've been watching with super keen interest just how all forms of sustainability are being woven into financial products. And so we're quite keen to be part of that journey and undertaking some of those instruments ourselves. You mentioned the two that we've done already that have been in the headlines, and I will just say, just personally, we're very, very proud of both. They were great opportunities as the treasury function, part of the finance function, to work with very diverse parts of the business as well. In our social and technological side of the business that we wouldn't typically interact with, certainly on a day-to-day basis, as well as interacting with new partners like the IFC that I certainly hadn't done so before. So the first was the loan with the IFC. That was $100 million for 10 years, and with the IFC, we're partnering with us in developing in many countries. And this loan is linked to the performance on our 2025 jobs and education goals coming out of the Sustainable Mining Plan for Anglo in South Africa specifically. And then we disperse this loan, draw down from it as we spend money on those projects. The second, more recently, I think about 3 weeks ago now, we issued a bond on the public debt capital markets. It was euros just under $750 million, also for 10 years. And this bond baked in the performance for our 2030 greenhouse gas scope 1 and 2 reduction targets, as well as water abstraction and job creation targets for 2030. So this was, anyway, well, our CEO likes to talk about sustainability and how it's woven into our into all elements of our strategy, because we don't have a single head of group sustainability or anything like that. We've been focusing on these issues for so long, and I think it's just a reflection that sustainability is good for business in terms of if you're using less energy, you're using less water, it is just, as I say, good for business. And so these instruments were about enhancing that message, leveraging that message, and just demonstrating the company's commitment to sustainability across different areas, and our keen commitment to achieving these goals. I think it was a good opportunity to engage with our debt investors as well. Certainly an opportunity to speak about the importance of mining in the energy transition, and the use of our commodities in batteries, in electric vehicles, and just how mining has an immense role to play, and possibly one that doesn't get enough attention. Equally in Anglo, we've been spending an awful lot of money and working with some great brains, bringing some really tremendous technology to the market to how something as dirty as mining is really having some great technology deployed to it in terms of how we can manage ore better and just use far less energy in extracting products from the ground. And so this was an opportunity about demonstrating all of that and how we're doing our bit to improve sustainability, in raising some interesting financial products and hopefully just supporting our ultimate goals of improving people's lives. Thanks, Wendy.
That's a
Back to you.
fantastic summary, Aaron, of a couple of really interesting and very practical examples of green finance. What are the lessons that you learned as you went through the process of both of those, the bond and the linked loan?
Sure. I think just, well, with the audience in mind, I can definitely say that sustainable finance and the risks associated with it need new brains and hard work, and that's certainly a very rewarding space to be working in. I think we saw that your debt finance and baking sustainability in it brings, I think, a level of detail and precision to our goals, that as much as they're in the public domain and scrutinized and in the minds of certainly our equity investors, this was an opportunity to bring it, I think, to the front of our debt investors' minds, and bringing it into a debt instrument on day one, I think brings a need for measurement and definition and reporting and transparency and commitments to all of that. That yeah, I think maybe we had internally, but certainly weren't as obvious maybe to our stakeholders as they are now, I hope. And I like to think that through the conversations that we were having with those colleagues in the social and technical spaces, that you know, as I bring that debt need for definition, that is also going to hasten the plans, and that they have to achieve these goals. I think additionally, in addition to that, just when you're issuing these instruments, they come with a need for third-party verification and review, and we welcome that. And again, I think that's positive, because I think it will increase transparency and focus on achieving these goals. So ultimately, I hope that we can go a little bit faster as a result of doing instruments like this.
Wonderful. Thank you so much, Aaron. Fernando, over to you now. So you're with the IFC, you were part of developing that loan. Let's hear from your perspective, your passion for finance, and perhaps a little about the development finance role that the IFC has, and then B, your perspective on the loan that Aaron's been speaking about, please.
Thank you, Wendy, and hi everyone. I'm very happy to be here. IFC is part of the World Bank Group, for those of you who don't know this, and it's the part of the World Bank Group that lends to the private sector. So it's a financial institution. I'm with IFC 15 years now. But I'm not a finance person. I don't consider myself a finance person. I would call myself more a development person. I was recruited by IFC some time ago to work on transparency and accountability around mining, which is something that I'm always been really interested in. And it's quite important in the case of mining, but increasingly more and more sectors. IFC works as a bank. It finances investments, but it also adds, in some cases, advisory work to what it does. And that's the angle that I came into IFC. Advisory work aimed at helping clients generate positive impacts on the ground around communities. And in the case of mining, we all know the potential is very, very great for positive impacts, but they don't come automatically. And that's some of the work that initially drove me to IFC, this developmental view. In the job I do now, I'm also involved in sustainable finance, and I was lucky to be involved in the operation with Anglo. One way of thinking of sustainable finance, in my mind, is to think of it as the point where finance meets development or these broader goals associated with the common good, the public good, that go beyond just the impact on the investor or the company involved. Sustainable finance is an area that, it has already been mentioned, has been growing quite rapidly. There's a lot of room for invention, for innovation, and that's taking place from green finance, which has some years now, focused on the use of proceeds, how the money is used, to newer forms like sustainability-linked finance, focused more on what is intended to be achieved. There's other things coming up like blue loans, and that's going to continue to happen. It's an area where there's plenty of room for new initiatives, for new ideas, but it's not an area for everyone. This is a segment of the financial sectors. In addition to the financial instruments that people can come up with, there's other pieces that come into play. And you can think of any different interesting instrument to promote sustainability, but you need on one side companies willing to use those instruments, as was the case of Anglo. It has to make sense to them. It has to connect with what they're trying to do. And that might not be everybody, depending on the instrument. You also, on the other side, need investors willing to put money into whatever's being promoted through this instrument. And again, that's not for every investor, but we see increasingly more and more investors that value progress in ESG, movements toward the SDGs, and that's part of what's driving this market. But when we think of this as a market or a system, we know that as it evolves, we're gonna see hits and misses. We're gonna have some very good experiences, maybe some others not so good. Part of what is in the news lately is the idea of greenwashing that we can touch on. But this is something that will be evolving as any dynamic system, with a very exciting point that there's much to be created, so as to get more and more companies in one way or another involved in trying to push this agenda that Lisa has made reference to. I mentioned I was lucky enough to be part of the IFC team that worked with Anglo. It was really quite exciting. I felt it was a great opportunity for me, again, because it mixes finance with this idea of development, of having an impact. It was exciting because it was something new, an innovation, but also setting an example that we hope others will follow. And that is always something that I love to do. It was also interesting to help a company move in the direction they want to go. And we all know how serious Anglo American is in doing these things, and whatever we can do to help is with the very ambitious goals they have is a great opportunity. And finally, because that type of operation, we focus on the financial instrument, on what's innovative. We focus on the company and doing investment, but at the end, much of what happens is on the ground with people benefiting from better education or better jobs. Again, the development angle, that to me is very, very exciting. Let me stop there for the moment.
Fantastic. Thank you so much, Fernando. Could you tell us, tell the audience, what are one or two of the top lessons that IFC learned through this process of developing the sustainability-linked loan with Anglo American?
Yeah. The first one, maybe not a lesson, but it was just a belief that was reinforced, is when you do this, you want to do it with someone that believes in it. And we were lucky enough to do it with Anglo. We shared very much the perspective on how we view this, and that's important. That makes everything a lot easier, even though it's not easy. One of the lessons, I think, it's going from intentions to the specifics is very hard. It's one thing to think of targets, this is what I want to achieve, but when the discussion becomes one of, okay, how is this going to happen? What kind of information do you have? And what do you need to track? There's a lot of questions that need to be answered. So there's much detail. Something else is that you can do this financing at the project level and have a relatively narrow focus, but you can also have this type of goals at the corporate level. And for large companies companies with a large footprint in different countries, you have additional challenges of how do you aggregate information across countries. That becomes a little bit more complex as you have different environments. Yeah, let me stop there for the moment.
That's fabulous. Thanks so much, Fernando. Great answer. I'm going to come back to Lisa, and please, to the audience, for those of you that are listening, please put your comments and your questions, particularly, into the chat. So we have one question that I'll come back to, and in the meantime, I've got a couple more. So Lisa, I wanted to ask you, reflecting on what you've heard from Aaron and Fernando, what are your thoughts? What comes to mind? What's burning for you? And then perhaps if you could talk a little about some of the other mechanisms that you're interested in pursuing to address that big gap that you have identified for sustainability and climate change and development.
Thank you. And I think I'm going to combine both of those because, first of all, it's wonderful to hear about the collaboration between IFC and Anglo and to learn about the products, which sound really exciting. My reflection as I was listening, which also goes to your question about what I see as the big approaches, is the following, which is that notwithstanding at all the need and the utility for these company-specific and project-specific products, which are can be invaluably helpful, as we've just heard. I think what is missing from the field is an understanding of the pathways to development, the overarching and interrelated pathways that are needed to address these complex development challenges and to achieve our goals, and into that pathway to understand the roles of different financial sector tools, the roles of different sectors, and how sectors should align with the pathways, what needs to, how different sectors will need to adapt their practices and or pursue new opportunities and so on. That we don't have that, actually. Governments don't even really have that, but the financial sector doesn't have that overarching understanding of what is the role, to Aaron's point, of the mining sector in the sustainable development challenges, and how do we use the resources that we have, the technologies that we have, and then the financing that we have to ensure that the mining sector is on that pathway, is able to deliver the products that are needed, but is mitigating its impact accordingly. And I would do that sector by sector, or transformation by transformation. So, and I guess let me just say that part of the reason I say that is that this product, I think, not surprisingly, the organizers of this forum have invited a really wonderful example of a sustainability tool, but not all are so successful and not all are so well designed. And so we have seen lots of so-called sustainability loans or sustainability bonds or green bonds or so on that are really misguided and poorly designed, and that fall in the bucket of greenwashing, of just giving good looks to more loans to companies that are really not serious about their sustainability commitments or their pathways. So it's wonderful to have leaders in the field to show us what good, positive financial tools can look like. We should recognize that there's a lot of room for bad products and tools too, and that I think it is in everyone's interest, especially that of the leaders, to be a part of a broader reflection on what are the pathways and what are supportive ways for financial actors to steer us through those complicated pathways.
Great comment. Thanks so much, Lisa. And I'll be really interested, Aaron and Fernando, I'm sure that you have views on what Lisa has just said. So I'd be interested in your reflections on Lisa's reflections. But I also am interested in the question of how do we incentivize so that there is a big gap. So what can we do to incentivize organizations to develop really good quality green finance that supports the broader sustainability agenda? So perhaps Aaron and Fernando, and then I'll come back to you, Lisa.
Got you. And I think I agree with what Lisa was saying. I think this is such a in financial product terms such a sort of fairly new area, and it's evolving so quickly. And and Fernando mentioned some of the other the blue loans which I've just started to read about. And in my role, I get presented to by a lot of banks trying to pitch these kind of products, and there was certainly an initial phase, I would say, probably about 2 years ago, at least that's when it was coming to me, of exuberance, and everybody was trying to take this product and turn it into a different way, and there was a different label, and everyone just had a new idea, and it's exciting, it's innovative, but equally you have to kind of look under the hood and just be careful what you're buying, and just sort of test out the credibility of it. And so I think even as long as we've been watching the sustainable linked loan and bond spaces evolve, I think it does seem to be gaining credibility and more review over time. And I think that's probably just a journey that needs to happen. I mean, things like the coupon on the bond that we've seen. When we saw a bunch of initial bonds, I think it was Enel first in the sustainability linked bond space. They came out with 25 basis points per KPI, and even I can't remember what the tenor was in that first bond right now, but what we're hearing and talking to our investors is that just they're starting to distinguish different coupons for different tenors, and they're understanding how that needs to play, or they want to see more coupons through the life of the instrument to penalize us or to reward themselves if we're missing those KPIs through the life of the instrument. So I think there's an evolution of terms and structure to go through. I think the legal framework behind all of this needs to evolve as well. There's a lot of stuff around buying back this kind of debt that I think could be quite murky. And that we thought about really hard when we were coming to market with this. I mean, for example, and I don't believe this will be Anglo, but if we get to year 8 of the 10-year bond and go, geez, we're not going to hit those targets, an unscrupulous player might want to go and buy that debt back and avoid a step up. And I mean, so that's I mean that clearly, I mean, it's manageable, but that needs to be dealt with transparently, I think, with investors. So wait, in terms of maybe what incentives for this, and I think I'm possibly shooting myself in the foot here a little bit, but I probably think that the incentives or the incremental step ups or step downs for broadly green finance need to be a bit bigger. I think the 2 to 3 basis points per annum on a loan that we see in the commercial loan space. I mean, that's not a huge amount in the life of a very big corporate. And so, look, equally, I think looking at the challenges we've got to achieve, I imagine just through carbon pricing mechanisms and that kind of thing, and maybe that just does naturally start to widen. And so I think maybe the premia for this kind of debt needs to become probably wider, but equally maybe then the incentives need to be more obvious as well, the financial ones, so that we can, if we're going to issue this form of debt, that there is a real gain up front, and that can be deployed back into sustainability related projects. Certainly it's been our experience, and we didn't really see it in the pricing of our bond, that it didn't sort of make that bond infinitely better, or have an additional premium to release. I think we saw that the bond book performed really well and was sticky and well held by investors, but I don't think that there's a tremendously different price for ESG related debt at this stage, and that's probably something that needs to change in future.
Oh, that's
a great answer.
Thanks very much, Aaron. So you and Fernando have both mentioned blue loans. For the audience, could you briefly explain what you mean by blue loan?
It won't apply to me, so I'll pass to Fernando.
Okay, thank you.
Okay, they're the ones aim at supporting activities related to what we would think of healthy oceans, the sustainable use of oceans. Briefly mentioned. I don't know if you want me to react to some of
Yes, I
the
do.
comments.
Yes, please.
I completely agree with what Lisa said in terms of there not being an overarching understanding of the pathways. Having that would be like a recipe. It would be wonderful. It would solve a lot of things, and maybe that's why we don't have it. It's just too big a thing to ask for. But then also Lisa went down a little bit talking about sectors, and I think maybe expecting them at those levels, it's realistic. It's still not easy, but it's realistic, and we should push for that. As she said, we're not there yet. In our experience, we sometimes talk with companies that want to consider green financing or sustainable financing. In some cases, you might even find companies that have committed to some targets, and they're not sure how to get there. And that makes you wonder. Now, as IFC, we're looking to provide support to some of those companies that have intentions and are trying to figure out the way to get there. But there's, it shows that one thing you need is players that are convinced that this is worth doing. And we still have much to do with regards to that. And that's where you see some of the examples that were mentioned in terms of misguided loans, greenwashing. In my mind, they reflect the fact that there's not a true belief or intention. And so part of this requires to get more converts into the cause of doing things right. And I don't know if preaching is the way to do it. I think there's much discussion to trying to convince. And more we see companies seriously looking into being more sustainable. But I think that when it comes to this idea of incentivizing, as Aaron said, right now I don't think we're incentivizing a lot. Much of what is happening, I think, is the reflection of interest of companies themselves moving in that direction, and they see something that fits what they're trying to do. I'm talking about the serious ones. Before moving in this direction or using sustainable finance, the one thing you expect is to see a company with a very serious sustainability strategy. And that's one thing you can quickly ask is, okay, you're doing this loan. Let me see. Do you really have a sustainability strategy that touches ground and it's very very specific, or is this just something that's kind of floating in the air? And what we see is that those that have serious strategies are very don't need a lot of incentives. They're getting some. But that's not what's driving things. It's their desire to do things in a better way.
Fantastic.
Clearly, if we want to get more players into that field, incentives will have to be, as Aaron mentioned, more significant.
Fantastic. Thanks, Fernando. And I have to say, with the next generation of leaders, there is such a strong connection in young people between the contribution, the desire to make a positive contribution, and the role of institutions, and so I feel very optimistic about that. Now, we've been given a 10-minute warning, and so we have a couple of questions. I think this question is from Yaron Zeev. So Ronald, this may be a question for Lisa. So Ronald Cohen, in his book Impact, suggests a framework to connect the financial world with responsibility towards society and the environment. any response regarding this framework?
So good question. It sounds like an interesting book, and I'll admit that I don't know the book and don't know the framework, but I do have really important thoughts on this, which is that while the financial sector does have absolutely critical both opportunities and, in my view, responsibilities, we also should understand the limits of what the financial sector can do alone. And I mean that not to let the financial sector off the hook, actually, but rather to emphasize the important role of government in setting the rules for both the private sector and the financial sector in a way that, in my view, actually, well, that primarily protects the interests of people and planet, because that is the role of government, but also provides clarity and consistency to the private sector and the financial sector. I think having clearer rules on expectations, liability, the costs of natural capital, which is, I think, raised in other questions and so on, should be, the clearer they are, the more helpful it'll be, to my mind, both the private sector and the financial sector. So as important as the financial sector is, and it is, and there are real opportunities and risks, we cannot lose sight of the important role of the government in assigning costs and liabilities to certain types of harms, in using its regulatory framework to guide and shape where the investment opportunities are. The government, through its own tools and regulations, can shape the incentives for the financial sector. Where is the government providing guarantees? Where is the government providing subsidies? Where are we assigning costs to certain types of financial transactions? What are we regulating with respect both to private sector activity and to financial sector activity? This is a critical function of government, and without these clear rules, no sustainability plan of the private sector, no financial sector initiative alone is going to get us on the pathway. I assure you that. So let's look to the financial sector to do what it can to understand its responsibilities, to help us mitigate the risks, to fund the opportunities, but all within a framework of looking to government to define those pathways and to shape the role of the financial sector and the private sector.
Yeah, that's very interesting. And my instinct on that is that if development still needs a great deal of understanding, then it's really collaboration between governments, the international development sector, and the private sector that can accelerate, that can really make a difference in terms of accelerating towards what's needed. We have another audience question here. This one's from Dan Morrison. Do we not have to assign dollar values to climate positive natural assets? If we value only palm oil and not the climate impact of Amazonian forests, then we will replace the entire forest with palm oil. Same for land with gold beneath it, etc. Who would like to take on that question? And I'm conscious that we've got about 5 minutes, so a very pithy response, please.
I can take a crack.
Fantastic, thanks, Fernando.
Ideally, I think if something like that could be done, it would make a lot of sense. The big question is, how could something like that be done? How could an idea of that sort be put in practice? And we're seeing something that's simpler than that, like carbon pricing, and how difficult it is to move with that in the agenda of using it more broadly. So I think that conceptually, the idea makes a lot of sense to me. The big challenge I would see is how applicable it can be at this point in time.
Yeah, great answer. Thanks very much, Fernando. And having been around in mining for a couple of decades at least, the ideas of natural capital and valuing natural capital have been developed over a long time, but I think those and valuing development still needs a lot more work. So young people, get to it. There's one other question. When excellent sustainability ideas arrive, how likely are they to be adopted if it lowers profit or requires delaying a project to incorporate? And I'm going to ask Aaron to respond to that question, bearing in mind we've just got a couple of minutes.
Can do, Wendy. I threw some thoughts into the chat, but in my first thought was just that I wouldn't assume that a sustainability idea was bad for business and would necessarily lower profit. Certainly, some projects, I guess. I mean, if it was maybe purely sort of social in nature, or even then, maybe that's sort of too short a way to measure it. But just I mentioned earlier, some of the technology we've been developing that is reducing the amount of water that's used in the abstraction of our products, or just the amount of power we're using to crush rock. I think there's some terrible statistic about the amount. It's either 1% or 4% of world energy goes into comminution and breaking big rocks into smaller rocks. So if you can do that smarter, we can spend an awful lot less energy, and that just then saves an awful lot saves an awful lot of money as a result. So that's tremendous for business. Even on the job side of things, I think to be working with young people, to be giving people education, to be training people, I think that costs, but the rewards for that I think are into the longer term. And certainly in our sector, I think it's part of maintaining the license to operate that we receive when we move into so many different geographies. But look, I think it's fair to say that there will definitely be areas where it's going to cost, and I think it's investors like us, when we choose where we put our money and we tick boxes in our pension fund allocations or the shares that we choose to buy. What are those companies that we want to invest in? What are they doing? What are they saying? And what are they actually achieving? And are we ourselves personally prepared to take a sacrifice and accept a slightly lower return for companies that are achieving sustainability? I think it's personally, I think yes, but I think that's probably at the heart of the question.
Fantastic. Some lovely, very deep questions there. Our time has come to an end. So I want to thank the panelists for a fabulous conversation. Thanks for sharing the big picture view of green finance. Thanks for talking about the products that you've developed, the bond and the sustainability linked loan. Thanks for talking about your perspectives from your different parts of the world and your different work, parts of the work in finance. And thanks to the audience for fabulous questions. It's been a really engaging conversation, and it's really been a pleasure to moderate the panel. So thank you so much.